From California, Mr. Royce.
Thank you, Mr. Chairman. Chairman Bernanke, I think most economists believe that creating a massive new entitlement, the health care entitlement bill that we passed, is going to add to our deficit. I don't think anyone in here believes that we're going to cut $500 billion out of Medicare, as we say we are in the bill, in order to help pay for it. So Congress is adding to the deficit. And on that note, in recent weeks, Berkshire Hathaway and Procter & Gamble and Lowe's and Johnson & Johnson's debt traded at lower levels, lower yields than treasuries of similar maturity. And essentially the market is saying it is now safer to loan to Warren Buffett than it is to the United States government. Now, Mr. Geithner disagreed with that conclusion or that assessment. I would just ask you your view, because I don't know what else it could mean. And I'd also ask if you've ever seen this in the bond market. What does this say about our fiscal outlook?
Well, it is very unusual, certainly. There are a number of possibilities. The one you raised, I guess, is one possibility, although if the U.S. government is not paying off, then there's going to be a huge amount of economic dislocation that would affect everybody. I think one of the issues recently has been, and this would be consistent with what you're saying, is that the U.S. government's very large debt issuances, there have been very big auctions with lots of borrowing going on, has put some pressure on the normal purchasers of that debt, and they've had a preference for diversifying into corporate debt, as you described. So,
but let me ask you about that, because the Federal Reserve, in one analysis I saw, purchased a staggering 80% of the $1.5 trillion of debt issued by the federal government last year. If we run $1.5 trillion deficit here, you know, somebody's got to buy it. And I think it was the PIMCO analysis that said that 80% of that was bought by the federal government. And I know there was some opposition from some people within the Fed in terms of doing that, but you've got pundits quipping that, you know, in essence, this is like a Ponzi scheme in a way. So with yesterday being the worst day since last July for 10 years for 10-year U.S. Treasuries, is the Federal Reserve considering getting back into the business of buying U.S. Treasuries, or are we laying off of that approach for a while?
Well, Congressman, that number isn't correct. We purchased last year $300 billion in treasuries, which was much less than 80%. And that total number brought us back to 790 or so billion, which is about where we were before the crisis. So at this point, the Fed owns the smallest share of U.S. government debt as it had for many, many years. So we are not monetizing the debt, and we have no immediate plans to do so in the future.
Let me ask you another question, and I appreciate your analysis on that. And I was struck when I read the analysis from PIMCO, and I don't know how they perceive the amount of government intervention into the market here. But let me ask you one last question. The Dallas Fed President, Richard Fisher, said of the easy money policy during the most recent housing boom, rates held too low for too long during the previous Fed regime were an accomplice to the reckless behavior. Now, I remember the Economist, the British magazine, arguing at the time when we lowered the Fed funds rate to what effectively was below inflation, that we were going to face a boom, a bubble in the housing market. And they also argued that because Europe would have to follow suit to be competitive, it was going to cause a bubble there as well. And year after year after year, that rate was held that low. And so I would just ask you, given the Fed's track record, what assurances do we have that the Fed will be any more vigilant when the next bubble begins to form? Is it even possible to take away the punch bowl, as they say, just as the party is getting started?
Well, Congressman, I don't want to rehash history, but I think there's a lot of conventional wisdom out there about the earlier episode. And I think when, you know, we've at the Fed, and we've published a paper looking at the evidence, and I think it's much less clear than some people would make it. But putting that aside, we recognize that the very low interest rates we have today that a number of people have been concerned about the possibility of creating a bubble in some asset class, not clear which one. And all I can say is that we agree that it's important to monitor what's happening in financial markets. We are doing that. And although it's very difficult to know whether an asset is appropriately priced or not, we do not see at this point any, I mean, if you have some views, you can certainly, we'd like to hear them, but we don't see at this point any major mispricing in important asset classes right now.
Thank you, Chairman Bernanke.
Yeah.
Gentleman's time